you. Okay, so thank you all for joining on behalf of Blockchain by Women. I want to welcome you to this event on CBDCs versus stablecoins. We're joined by a wonderful panel here today. Before we introduce them, I do want to introduce the other folks from Blockchain by Women, Marina and Marzan. If you could just wave hello, thank you. We appreciate them. And it wasn't without them that in their efforts or without them, we would not be able to be here tonight. So why don't we first go through a few quick housekeeping items. We'll go through the content. We have a number of questions that we wanted to address. And as you have questions in the audience, please put them into the chat and we'll incorporate them into the panel as we go along. If we miss any, we will certainly queue them up and make sure we answer them at the end of the panel. And please also watch us on YouTube and other sessions that we have. We'll be sending a link out later. So if your other colleagues would like to watch this panel, we'll have a recording ready and it'll be on that YouTube channel. So before we get started on the panel, I wanted to do a quick round of introductions. So I'll start off with myself. I'm Karen. I'm founder of Blockchain Intel and one of the founders of Blockchain by Women. Blockchain Intel does blockchain analytics to prevent fraud and safeguard applications. We started Blockchain by Women to increase diversity in this space, as well as education in this very fast and rapidly developing space. So I want to hand it over to our panelists today. Helene, do you want to start?
Sure. Hi, everyone. I'm Helene Kim. I am a co-founder and the research director of the newly established Digital Currency Initiative at Stanford University. We are just getting off the ground, and I think the topic that Karen has identified today as our organizer and moderator is a really important one because I think it's very timely. So I'm really happy to join all the panelists and especially want to thank Karen.
Ashley?
Hi, everyone. Thanks for joining us. And thank you to Blockchain by Women. My name is Ashley Landquist. I'm a project lead of blockchain and digital currency at the World Economic Forum. You may know the forum from the annual meeting at Davos, but we also have a large technology headquarters based in San Francisco, where we work on governance and policy issues relating to emerging technologies, digital currency and blockchain being one. And that's the team that I work on, and I lead the forum's work on central bank digital currency. And I also manage projects related to stablecoins and other efforts.
Fanny?
Hi, I'm Fanny. I'm a lawyer and an entrepreneur in the cryptocurrency space for the past 4 or 5 years. Most recently, I was Associate General Counsel at MakerDAO, which is a decentralized stablecoin project. And recently, I've been working on a variety of really fun projects looking at how we can use stablecoins in the context of UBI, cash assistance, community development, and other initiatives around financial inclusion. I'm also very interested and have done a bit of work around digital identity and how it's important as a fundamental infrastructure for cryptocurrency.
Shaylee.
Hi, everyone. First, thank you to Blockchain by Women and Karen. This is a great panel that you put together. So Shaylee Adinolfi, I work with Consensus doing business development in the Americas and actually more broadly, globally, focused on CBDCs, payments, digital assets, and different types of trade solutions, working a lot with governments and private sector. Excited to speak with this group.
And John.
Hi, thanks Karen for organizing this and Blockchain for Women. Hi everyone, my name is John Ho. I'm the head of legal for financial markets for Standard Chartered Bank. Been involved in quite a number of fintech and digital currency initiative on behalf of my organization. I'm also the mentor for a couple of blockchain startups and fintech companies like R3, Enterprise Ethereum, and most recently, I'm a mentor for the UK FCA Digital Sandbox experiment. Thank you.
Well, thank you all. And you know, it hasn't been easy getting everyone across all the time zones together, but I really appreciate it. So first of all, we want to do a level setting. Ashley, could you give us a description or define wholesale versus retail CBDCs and stablecoins?
Yes. Okay, everyone. So to level set, related to CBDC, and keep in mind, CBDC is very distinct and different from stablecoins. So for CBDC, first of all, you can think of two different types, retail and wholesale. Both types are sovereign currency or central bank money that is digitized, and it's a liability of the central bank, meaning it's redeemable directly by the central bank. On the retail level with individuals or with stores and shops, we have access to central bank money only in the form of physical cash. Financial institutions already have access to digital central bank money in the form of reserves that they keep at the central bank. So what central bank digital currency is digitized sovereign currency access on the retail or wholesale level. And on the wholesale level, like I mentioned, we could think that it generally already exists. Basically, commercial banks and other financial institutions already have access to reserve accounts with the central bank where they deal digitally with fiat sovereign currency. As a result, most wholesale central bank discussions that central bank digital currency discussions that you might hear of, all the experimentation and research work happening, either centers on upgrading that domestic system in some manner, maybe with blockchain technology to potentially make it better, or opening it to foreign financial institutions to also hold accounts with the central bank and transact in that central bank's sovereign currency. On the retail level, as I said, we don't have access to the digital sovereign currency yet, but we would have access to it if the central bank digital currency is universally available within that country. And an economy could decide to allow cross-border access to that central bank digital currency, meaning foreign citizens, tourists, or foreign entities who may not be financial could also have access to it, but that's going to be determined on a country-by-country basis. A quick mental model would be basically we're talking about accounts with the central bank on wholesale or retail CBDC. So there's different arrangements on how to actually do it, but you can think, okay, basically retail CBDC means citizens would be able to have accounts at the central bank, and wholesale means commercial banks would be able to, which they already do. So maybe we upgrade that system, or we allow foreign financial institutions to also have accounts at the central bank. And as a result, settlement can be a little bit more quick and direct from overseas entities and with the domestic ones, because everyone can settle and clear the payments with the central bank because everyone has accounts at the central bank. That's the idea.
Great, thanks, Ashley. So in 2020, the market cap of stablecoins went from 5.3 billion to over 13 billion. Where do you see stablecoins going and gaining adoption today? Either as on and off ramps for cryptocurrencies, hedges against inflation. Where do you see stablecoins going in the future? So in a nutshell, what are the use cases for stablecoins versus CBDCs, and where do they fall?
Are you asking that to me or?
Yeah, so this is for Shaylee and Ashley.
Shaylee, do you want to start since I just spoke?
Sure. I think in the near term, we may see use cases for stablecoins in the retail space. I also think there's been an upsurge of stablecoin usage, things like DAI, for example, because of what's happening, the innovation that's happening in the Ethereum ecosystem with DeFi, decentralized finance. And right now, there's a lot of speculation happening in the DeFi space. I won't lie. I mean, people are just trying to have quick wins. And there's new lending protocols coming about. There's a lot of interesting innovation that's happening with those stable coins in DeFi. And that is being looked on by financial institutions. And as a result, they're looking to innovate in this space as well. They're seeing what's happening in DeFi and looking to do similar, leverage the technology in similar ways. So I do think it's going to take time. There's also been some pushback by regulators on stable coins. We saw in the US introduction of the Stable Act, and we can talk a little bit more about that. We've seen that the European Central Bank is, hesitant about Libra and has said some things against stable coins. And so I think more governments are interested in testing central bank digital currencies, and there are some governments that are reluctant on stable coins. So it may take a little bit longer for stable coins to find their way than CBDCs.
So
from what I'm seeing.
Yes, I'll just say as a small business owner here, I love stablecoins because I pay my employees out in stablecoins because they're in different countries. So why do I have to go and convert currencies when I can use stablecoin much more efficiently and inexpensively? So I think stablecoins are great for whether it's cross-border kind of payments or on-ramp off-ramps to cryptocurrencies. But what are some of the CBDC then use cases? Because I'm still skeptical and just wanted to understand.
Yeah.
And maybe you could talk to that. And Helene, I know you had some thoughts here too.
And Karen, it's good to be skeptical. Actually all major developed economies have not, or no major developed economies have indicated that they have value in creating CBDC in the near or immediate term. And that's because generally the benefits that it can provide don't outweigh the downsides and limitations that it has. In emerging economies, that equation could be a little bit different. But in the developed side, some use cases that we see from industrialized economies in Canada, US, or Euro area, they could be things like providing citizens access to a sovereign currency if physical cash usage dwindles and the central bank decides it needs to step in and play a role and provide physical cash so that people continue to have a reliable source of a means of payment and a store of value that they know that they can redeem at the central bank. And it could include preempting uptake in the country from big stable coins that could get issued. The general fear here pertains to people like issuers like Libra, or even foreign central bank digital currency. An economy could get heavily adopted domestically. So the central bank could think, okay, we're going to introduce this CBDC first and preempt that or counter that competitive threat. They could also issue for payment system efficiency. Like I said, they open cross-border access, then citizens could settle with cross-border parties for financial or retail more efficiently because everyone has an account with one central bank. And then in the developing economy, other major use cases include financial inclusion, which isn't yet clearly established whether exactly it'll help. I think it really depends country by country, but we could think of ways it could help with financial inclusion and maybe upgrading or increasing the resilience of the domestic payment system if a strong one doesn't yet exist. And then wholesale CBDC, it could be about thinking of new ways to perform cross-border interbank settlements and payments between foreign commercial banks in a way that's more efficient by everyone having accounts with one central bank or transacting across CBDCs. Other things like maybe capital markets use cases, like, okay, let's say in the future we're going to have bond issuance happening on blockchain and or something like that, and the CBDC could facilitate that transaction. So anyways, I've listed several, but there are several, but the countries have to weigh individually whether these opportunities really make sense given limitations and downsides, which are well researched and evident as well.
And Helene, do you have thoughts on this
Yeah, I'm very interested in the potential substitution effect of CBDCs as it relates to trade settlement liquidity, because as I understand, a lot of the original use cases for stablecoins, especially what you would call native stablecoins that are part of like a trading platform, really have to do with providing settlement liquidity for trade execution. So to that extent, because we're seeing greater institutional adoption of cryptocurrency assets, both on the asset management side as well as on institutional trading platforms like a Gemini or a Fidelity, the new Fidelity spinout, it seems that that has become a very primary function of stablecoins. I'm just wondering at what point some CBDCs, but not all, might try to supplant that settlement liquidity role. And I believe it will have a lot to do with whether those currencies have an extra, what I would call an extraterritorial reach in terms of their jurisdictional limits. So as you know, some currencies are based on soft currencies where there are issues about capital controls, capital flight, whereas hard currencies tend to be more kind of borderless in their nature. So this is a question that I would actually more have for our very esteemed colleague here, John Ho, given that he worked with Standard Charter, and whether he sees any potential for stable coins in that settlement liquidity function being replaced by CBDCs off in the future.
Yeah, thanks, Helen. I think that's a great question. I think as Ashley mentioned, as of today, we haven't seen any live CBDCs, but I think the concept of CBDC is one where the recent BIS report says that at least 66 central banks around the world are either trialing or considering in some form or shape the issuance of CBDC. But to your point about the replacement or using CBDC to replace or substitute current payment or digital payment methods, that certainly is one of the sort of consideration, or rather the scenario that central banks are looking at. Just by way of example, what I mean by that, if central banks are looking at a number of scenarios, so one is for cross-border payments. As we know, cross-border payments right now, the current landscape, it is fragmented, it is expensive, it is slow, and it relies on a network of correspondent banking, which obviously has its own risks associated with AML, KYC, largely mitigated, but still the risks are there. But I think the questions about the cross-border is one that will require a multilateral response from a number of central banks because of its cross-border nature. Now, if you look at a more recent project called UBIN4, Project UBIN, led by 3 central banks, Bank of England, Bank of Canada, and Monetary Authority of Singapore. In the UBIN4 scenario, they did look at the hypothesis of a delivery versus payment. And one of the scenarios was the use of a central bank digital currency to settle transactions between central banks. Now, in terms of the proof of concept, the outcome shows that it works. But the challenge is the current sort of payment rails. As we know, different jurisdiction uses different systems. And then your issue about interoperability comes in, and you need to understand whether, how do we achieve that? So there's one concept in terms of the aspiration where the regulators are intending to achieve. But I think the reality, as we all know, is the current challenges with respect to scalability, interoperability, and also more importantly, the legal status of a CBDC needs to be resolved, not just on a domestic basis, but on a cross-border basis. What is it? And I think if you look at CBDCs in most jurisdictions right now, the current laws do not contemplate a central bank money in a digital form. And I think that regulatory clarity needs to be resolved first, followed by there are 2 aspects, the functional capability and also the non-functional capability. As Ashley mentioned, you have monetary and sovereignty policy that needs to be considered, financial stability risk, because if it's a wholesale CBDCs to facilitate interbank payment, that's one thing. But if you're looking at a retail CBDC, there are a lot of concerns about financial intermediation, disintermediation of the financial system, because if retail can hold CBDC directly, then the big question is, what is the role of financial institution? What role do they play? Would they crowd out funding? Would they increase funding among banks? Because right now they have to compete. And I think these are obviously fundamental considerations that, frankly, the central banks haven't sort of overcome yet, because they've done a lot of proof of concept, but I think the proof is in the pudding.
Yeah, I just want to add to that is that I think central banks are trying more and more to do their proofs of concept along with commercial banks so that they understand what's happening with intermediation in the future. What does that look like? And they want that, so they're bringing along the central the commercial banks in the process so that whatever they do build, if they decide to move forward to production from proof of concept, like with Hong Kong Monetary Authority, where Consensus is actually doing a cross-border use case, you know, they're trying to see how the commercial banks kind of feel and how they react to this type of proof of concept. What does it mean for them in the future?
I think for me as a user and also with my legal mind thinking about this, the critical question is, if I'm simply using this for, say, you know, improving settlement times from T+2 to T+0, does it matter for me as a counterparty to a private transaction that the claim that I have for this stablecoin or the CBDC, does it matter that I have a claim against a central bank, a public entity, or does it matter if I have a claim against a private entity, a regulated private entity like a bank, or something that has bank-like regulatory protections for me, right? Because if it doesn't matter that difference, then why would I necessarily want to care if I'm using a CBDC versus a private stablecoin that has the right regulatory, you know, protections for me as a user, ultimately knowing that there are funds sitting in a FDIC insured bank account, and as long as it's just easy to use and I have enough assurity that that somebody is good for this credit, right? So it's not entirely clear to me that CBDC is necessarily like we've lost all trust in banking institutions and other, you know, private financial regulatory institutions, that we have to use the government as the backstop, that, you know, that's the only source of trust that we have for settling our claims. So it, you know, that could also play into how we think about what are the actual relevant use cases.
So the OCC has communicated that banks are allowed now to hold reserves of stable coins, one-to-one fiat currency reserves. MiCA in Europe, new regulation in the EU, has parts that are specifically targeting stable coins, in Libra in particular. What input or data or guidance would you give regulators so that we have an environment that fosters innovation at the same time we're protecting people from bad actors? And since of the space where I'm in, I'm really concerned about that. Is really protecting whether it's consumers, retailers, or others from enterprises from bad actors.
Okay, I'll take that. Or John, would you like
go
to
ahead,
go
Helen.
first?
Go ahead.
I was just going to say that it's not so much my recommendation, but I expect that with the advent of something like the Libra or DM coin, which is really going to change the kind of potential systemic impact of these stable coins. I mean, they're calling it like a super stable coin or a global stable coin, because, you know, it's one thing to have 5 billion in balance sheet liabilities. It's another thing to have 2 billion Facebook users potentially, you know, creating 50 billion in balance sheet liabilities. I think at that point, the regulators are going to become far more concerned about two aspects that I think things are a little bit hazy on. One is the kinds of capital reserve ratios that will be required, similar to what you would have for regulating money market instruments that are pegged to $1. And second, I think there's also going to be more concern about monitoring the quality of the collateral that is backing a sovereign fiat currency. So I expect, it's not so much my recommendation that that will happen, but I expect that that will naturally happen on the regulatory front, simply because of the potential systemic impact of something like a DM coin.
Yep. Just to follow on what Helen mentioned, right? And in response to your question, Karen, on the regulatory landscape, I think just on the international level, G20 last year has sent a communication that the digital assets in the context of, they use the word crypto assets, is obviously doesn't at the moment pose a systemic risk to the financial system globally. However, the market share of stablecoins, cryptocurrencies, and the adoption has rapidly increased to the point that the regulators now are taking notice of it, and they have sort of advocated a multilateral approach among the G20 countries. And they have obviously mandated the Financial Stability Board and the other international setting body like Bank of International Settlement to come up with a framework, a regulatory and a legal framework to sort of how do we regulate this sector, but at the same time promote innovation. And I think closer to home in the United States, just last week, the US Treasury, together with other US regulators, in its most recent US Treasury report on the Financial Stability Oversight Council report, they've said they call on US regulators to work together towards a consistent, and I stress the word appropriate, regulation of digital assets, including stable coins and CBDCs. And the term they use is they need to balance between fostering innovation and mitigating any novel or new risks associated with adopting innovative technologies such as DLT, blockchain, or tokenization. Having said that, they're now aware that, look, the world's moving towards a digital space in light of post-COVID. I think they realize that how do we enable digital assets framework, but at the same time mitigating any risks with respect to the adoption. And I think what we're seeing as a shift of a tone from the regulators acknowledging that the use of digital assets in some form or shape, whether it's a private side or CBDC, it's the trends likely to come. The question is, what sort of framework does the regulator need to put in place such that it promotes innovation, but also mitigates any risk that comes about?
So I just wanted to pause and go to some of the questions here in the chat. One here is concerning the European Commission draft Markets and Crypto Assets Regulation, MiCA, that aims to bolster consumer protection of asset referenced tokens. What type of technologies can be deployed to foster open source embedded regulation that can be audited by other stakeholders? So I have an opinion here and would love for others to chime in. So what we've been talking about is really sharing and through self-regulation, and talked to a lot of organizations who are self-regulating bodies about a risk score that they can share with their auditors, with others. And that risk score is tied to, say, certain activities that are good or show good credit, responsibility, and also show any kind of tie to, say, potentially bad activity, right? And so these are characteristics, these are indicators basically that you're sharing with others that you have a control, that you have an understanding, whether you're a business or personally, of the things that you're doing. Of course, this is not intended in any way to impose on anyone's privacy, but to basically share, look, we have an understanding, we are upholding and self-regulating, and we understand what we're dealing with. So anyone else want to comment on that question here or provide their viewpoint?
Yeah, I'm reading the comments and I'm smiling because I think part of what we can empower regulators to do is to use the actual technology to automate regulatory reporting and compliance. So DFS is, which is the New York Department of Financial Services, they're the state level regulator for banking activities and includes crypto activities. They're hosting workshops next week around this very topic of how do we use this kind of technology to automate our actual reporting compliance obligations. So I think it applies best probably in the context of purely native on-chain applications such as decentralized finance, because everything is visible, and there's a lot to still be done in terms of making that on-chain data usable for compliance reporting purposes. So if you've got a stable coin that is not dollar backed, but is collateralized by other digital assets, right? We can see all of that on chain, and we can have certain metrics in terms of what's happening in that protocol or in that network. Are there particular types of risks that are unique to this type of stablecoin that we can use on-chain analysis to monitor for and create this kind of risk metrics for other types of stablecoins that have fiat or real world assets, right? And I think this is also where the law traditionally comes in and says, well, if you're a bank, you're in a fiduciary capacity holding people's assets against which your customers have a claim against you, then you're going to need to do X, Y, and Z, such as capital requirements, auditing, reporting, and so forth. So that already is in place. And I think some of that could also apply in the purely digital DeFi context to provide additional investor and consumer protection. But conversely, we can also, in the more analog world, bring some of that visibility onto a blockchain via attestations from these regulated entities as well.
Mm-hmm. I'll just mention briefly and follow up to that the BIS recently put out an excellent report referring to what the authors call embedded supervision, this idea that you can design compliance specifications right into the tokens. And so that might be a paper that whoever asks the question might want to take a look at.
So let's talk a little bit about what the working groups are doing and what they're debating. We talked a little bit before around the need for standardization and interoperability, but what are the key issues related to privacy and confidentiality related to stablecoins versus CBDCs, and what are the trade-offs and requirements in terms of the regulation related to that? So this is a question for anybody who wants to jump in.
I mean, the working groups that I work on, I'm co-chairing the International Securities Services Association, ISA, CBDC and stablecoin working group. And there we're looking at use cases specifically related to wholesale CBDCs and cross-border. And within that context, we have not yet touched on privacy, but honestly, I don't think the barrier is the technology. The barrier is a government and jurisdiction deciding what it wants to do. You can't have both, like a back door and then claim you want the privacy, right? Like the government has to make that decision, and they can't have it both ways. I mean, I guess they can have it both ways. They've had it both ways since, like, it's been a while. But so the pseudonymity conversation is happening. I think there has to be compliance with obviously AML, CFT regulations, FinCEN regulations, which you all know more about, especially Karen, and the travel rule that was recently issued. But I think this is going to be a longer drawn out discussion that will come down to new standards. And it's going to be, and it depends on the jurisdiction and the government and their regulations.
There's also important trade-offs with financial inclusion and access and compliance that need to be considered. Of course, people who may not have government identification and are financially excluded can't generally participate in banking and cryptocurrency activities because the exchange, in the case of cryptocurrency, the exchanges require identification for know your customer in many countries if they're regulated, and you need to link your bank account to the exchange and to fund the purchases of cryptocurrency, and the bank requires KYC, and maybe you don't have a bank account but you use some Bitcoin ATM or something to purchase cryptocurrency without needing that, but then there are really high fees. So there's a lot of trade-offs between access and inclusion and compliance.
Yeah, and I just want to mention, sorry, really quickly, I in a lot of places they have the tiered KYC levels, and I'd love to see those tiered KYC levels applied to cryptocurrency as well. Right now, because there's a lot of, I just don't think the cryptocurrency world is treated the same with regards to regulation, and it would be nice to have that same application of the regulation.
Yeah, to Shaylee's point on the travel rule and tier KYC, it seems that on the one hand, we're trying to say financial inclusion, but there is a regime shift towards greater law enforcement oversight around the Bank Secrecy Act. So this is all around know your customer, anti-money laundering, and also on the international level with FATF. So there is a proposed rule from Treasury around travel rule to lower the threshold from a $3,000 transaction right to $250. That's quite a dramatic that's quite a dramatic reduction, and that would put a lot of lower income folks into that net, especially if they don't have identity documentation. And then there's an open question about whether the travel rule will apply in cases where you have unhosted or self-hosted wallets, in which case they're technically pseudonymous because there's a public blockchain wallet identifier, but they're legally anonymous, right? So that kind of directly is in conflict with some of the privacy principles.
Yeah, just to add to the debate, I think one of the things that in terms of the sort of consideration by central banks is this concept of how do we address concern relating to privacy, confidentiality, and how do we ensure that, as Fanny mentioned, that the bad actors with respect to the sort of acts relating to AML KYC are also addressed. And I think one of the things that have floated in terms of the CBD design is this concept called controlled anonymity, i.e. that the regulator would say that if you are going to go about doing your normal stuff, we don't want to see it and we respect your privacy. But if for whatever reason there's suspicious activity report that's being sort of detected in the crypto exchanges or the financial system, then we want to know about it. So I think that might be the sort of trade-off in that sense, but it's still in that sort of basically design stage, because this is one of the fundamental debate right now about if you have CBDCs, then will the central bank know everything that an individual do that in respect to the CBDC activities? But at the same time, to have complete anonymity doesn't cut it, because then you may allow people to do money laundering and KYC, and CFT sort of activities. So I think it's that sort of striking the right balance and ensuring that we address confidentiality and privacy where it counts, but also making sure that CBDC is not used for any illicit activities. And that's the trade-off, and that's the that's the balance that it needs to strike.
I think technology itself, again, can also be used to maybe address that tension. So if we had an infrastructure for digital identity that was built alongside CBDC or other kinds of stablecoin transactions, right? And we can use things like zero knowledge proof techniques. So all I might need to know on a public level is that these are transactions between wallets that are KYC verified. And I just need to know what institution verified it, but I don't need to know the underlying personal identifying information of that particular individual who holds that wallet, right? So that could be another solution where the technology itself can actually help with its own regulatory compliance.
And so to just add to that, I mean, how about instead of just looking at the profile of a person, look at really the behavior, the on-chain and really the related behaviors that are unrelated to a specific, KYC sort of thing about a person, but looking more at what they're doing on chain and using that to understand risk, as opposed to making everyone go through the process of KYC. I mean, yes, understand there is a place for that, but really looking through the lens and scoring the risk related to behavior, which
in that
anonymous. Yeah.
Let's say there's a bad actors identified, and then you blacklist their addresses. I guess their wallet addresses, maybe their IP addresses. Couldn't they easily just spawn up more addresses and start to engage until they're caught again?
Yes, so that is possible, but there are ways to tie those different actors together, again, through the behaviors that you see on chain and monitoring those behaviors.
One thing I'd like to mention as I think a challenge in this space is interoperability. I don't think we can emphasize enough how much of a barrier that is to true adoption in this space, particularly for CBDCs I'm referring to. And if you look at the fact that half of all CBDC pilots right now are aimed only at a domestic circulation base, meaning they're not really even thinking about expanding the reach of their circulation beyond their own borders, you're really kind of back to the same square one that you have with traditional currencies, which is this interoperability issues. So that implicates Forex considerations, there's technology concerns, but I think a lot of it is also, again, this jurisdictional reach problem, because if you think about how all these KYC, AYML, all of these considerations are unique to a particular jurisdiction, how do you standardize all of that? And that's really not a technology problem, that's just more of a kind of a regulatory standardization issue to get everyone on the same page in terms of even the compliance standards. I personally think that is one of the biggest challenges, interoperability, not just in the technical sense, but also in this regulatory legal framework sense.
Yeah, and I just want to add to that because I think governments realize now, the ECB has said that they definitely want the digital euro to be circulated outside of the EU as a part of their experimentation in their report that they just issued, and they're issuing an RFI soon, or RFP early next year. And you know, Hong Kong is doing cross-border experimentation with Thailand. Thailand has their own retail CBDC. So some of this cross-border and interoperability work is already happening with proofs of concept. You know, between Quorum and Corda, that those interoperability conversations are already happening. You've got token standards. I mean, I come from the Ethereum ecosystem, so obviously I have a bias for the ERC token standards, but they are very widely adopted, and a lot of central banks are doing some testing leveraging those token standards. But yes, I agree. I think there's swaps, there's bridges, there's hash time lock contracts. There's a lot of discussion happening around currency swapping, interoperability, how the currencies will be exchanged at the retail and wholesale level.
Mm-hmm.
So taking a look at governance from a different perspective, how have stablecoin protocols managed risk for users of the network or the networks? How do policymakers manage risks with CBDCs then?
I think the risk will depend on the type of stablecoin it is. I know there's a few different flavors of stablecoins, and they have different attendant risks, and the taxonomy of risks I think determine the taxonomy, what kind of stablecoins they are, and therefore what kind of regulatory regime they should fall under, who should be their prudential regulators. So if we're talking about stablecoins that aren't fiat backed one-to-one, but they're collateralized in other ways with other digital assets. Is it a basket of different assets that we're now, right? Because if there's asymmetry between the price or the value of the underlying basket of collateral relative to the price target, then there's some kind of active management that goes on to ensure that we can still reach a price target. So I mean, there's, you know, the question, of course, is are certain types of stablecoins securities, right? So there's a set of regulations and regulatory regime around that, because now you're managing a basket of assets to reach a target price. So that comes with a certain set of fiduciary type of obligations and reporting obligations and information disclosure regimes under the securities laws. If we're talking about one-to-one backed stablecoins such as USDC or Paxos dollar or Gemini dollar, there, then the question is, okay, so you have one-on-one backed. How do we know that you've got proper auditing of that? Then you're keeping those assets in FDIC insured banks. Those banks have capital reserve ratio requirements. There's still open questions around the consumer rights to redeemability of a stable coin. Even if you're holding something like a USDC, which technically has a regulated structure. And this is in part what MiCA coming out of the EU is trying to address. And they're explicitly saying if you have a stable coin, any holder of it has a right of redemption against the issuer. Currently, that's kind of gray, right? Like if I have a USDC, I can't exactly go to Circle and demand a US dollar in exchange for that. I have to be on some exchange like Coinbase, which incidentally is part of the issuer group for USDC. But in that interaction, I'm a customer of an exchange and they give me dollars, right? But it's not quite the same type of legal claim or legal relationship or legal right that I have for the underlying value. So that's one of the, I think the biggest actual consumer question outstanding around those type of stable coins. And of course, there's also an open question about how they manage their cash reserves. If you're looking at the Investment Advisor Act of 1940, there is kind of this threshold that it's 60% of your cash reserves have to be held in actual cash. Otherwise, you start running into, again, the securities law question. You're now managing a fund to meet a certain price target. So as interest rates drop, this presents a lot of problems. Banks become less profitable. These stablecoin issuers also become less profitable because the name of the game is having lots of reserves and earning some kind of interest return from that. So there's a question as well, without greater regulatory oversight, does that force these stablecoin issuers to put the reserves in riskier assets to make a return? So that's another open question. And then with CBDCs, I think Ashley can speak more towards that, or it's just stablecoins with this kind of systemic risk, which has been a big issue around Libra. Is that if you've got all these massive reserves and then there's a run on the bank scenario against, or just redemption scenario all at once, then that could actually have an impact in the actual underlying native sovereign currency. But Ashley could probably speak more towards those risks.
And bridging the concepts, if there's high usage of a stable coin, then that stable coin reserve is going to take up a lot of the very low risk assets in terms of high quality treasury and sovereign bond securities, which could affect the price of those securities and affect maybe central bank operations and monetary policy operations. So that's on the stablecoin side as another risk. So on CBDCs, you don't have this issue at all about redeemability of the digital currency for the fiat currency because it is the fiat currency. And I think that's one of the reasons why users would prefer it to stable coins, although we don't know where and how widely CBDC will be issued. So it might not even be competitive with a CBDC, with a stable coin in a region, because it might not even exist in a region. But taking a step back, I think the key risks and governance and risk management issues for CBDC are first the economy making sure that there's a real point to having a CBDC, that these benefits that I mentioned earlier in the talk really provide value and that they can't be achieved through regulation or alternative methods. And then if this economy does, if the central bank does decide to issue CBDC, there are a number of risk management thoughts that they'll have, some pertaining to financial stability, similar to the ones that Fanny was just mentioning. They could cap the size of a CBDC account. They could cap the transaction size of a transfer. And different risk management related to compliance and tiered KYC on accounts as well, and just several others, making sure that the technology is really secure and safe, and mitigating cybersecurity risk would be another major one, because imagine this economy now hosts, the central bank hosts savings of all the citizens in the economy. Maybe the balances are low if they cap them, but it would be a big target for hacking activity that can compromise not only the savings of the citizens, but also their data.
Right, they're all on mobile devices too. So let's take a look geopolitically. China has released its digital yuan, giving away 1.5 million to 19.3 locals. And steadily around the world, like others have mentioned, central banks have announced their projects. Realistically, how far away are we from CBDCs being released beyond small trials? And what's the likelihood that certain central banks will force their partners, maybe smaller partners, to use their CBDC? And what would the ramifications be?
Karen, let me start from the Asia Pacific. I think what we see in China is instructive. As you note, China have been doing trials in a number of cities, looking at different use cases from financial services to logistics to payment. They also, Starbucks and a number of US companies that have activities there have also participated in some sort of a trial. What that trial have shown is that in small micropayments, a CBDC does work as a mode of payment, as an alternative to just e-money, as alternative to stored value facilities. I think what's interesting is that one of the things that the central banks are concerned about is the current monopoly by quite a large big tech there that currently controls the cashless payment system. And I think the idea of the CBDC is to allow an alternative mode of payments and also allow parties to hold CBDCs in a digital form. And I think at the very beginning, those probably started on a domestic level. They would have aspiration as well to trial it cross-border, but that is obviously the second stage, because as you know, China now is the biggest creditor in many parts of Asia, Africa, and Middle East. Mm-hmm. And I think that dovetails with the sort of internalization of Chinese yuan and also the One Belt, One Road initiative that they're looking at. But I would say that the current trial that we see, at least on the public information that is made available, it has shown that there is a network effect with respect to the adoption of the CBDC based on some of the trials they've seen, and the use cases do show that the system is robust. And having said that, they're not really using blockchain technology at the moment. They're relying on existing payment rails to sort of test the hypothesis.
Are there differences between developing and developed countries? Oh, right, go ahead.
I was going to build on what John said about this Chinese experiment. I think a lot about this, how this distinction between soft currencies and hard currencies is sort of being, you might say, deconstructed by CBDCs. And if you think about in the case of China, how the perennial topic of whether to float their currency has been offset by concerns about capital flight controls, it seems to me, and I'm just purely speculating, but I had the opportunity for years when I was at UC Berkeley on the law faculty to work with the leadership of a lot of state-owned enterprises who are expanding globally on their legal and regulatory frameworks. And if you look at kind of the policy objectives of the Chinese government in this digital yuan experiment, it seems to me that my guess would be that you're going to see sort of a bifurcated scenario where on one hand, you're going to see the digital yuan for consumer purposes restricted to a domestic circulation base, similar to how a lot of soft currencies operate. But then on the other hand, I think it's also possible to program in kind of an embedded supervision layer where these state-owned enterprises will then be allowed to use the digital yuan as a means of global trade settlement, which is consistent with their Belt and Road Initiative objectives. So I think it's very possible that, with these programmable tokens to actually target two entirely different use cases like that with the same CBDC and achieve those kind of bifurcated objectives.
Any other thoughts on that one before we move on? Okay. So we just wanted to end. There are a few questions here, but before we go to them, I wanted to ask our esteemed panelists here, what projects are you following the most or most excited about, whether they're CBDCs or stablecoins?
I would like to start by saying Project Ubin out of Singapore is one of my favorites. They've been experimenting, getting their hands dirty and experimenting on a lot of different use cases for 3 years now, okay? And this is So people say, oh, like central banks aren't doing anything. Yes, they are. Look at Project Ubin 1, 2, 3, 4, 5, 6. I think they've had 6 papers and written a lot of excellent, there's a lot to learn from their papers. And they've made some conclusions. I mean, they seem bullish on CBDCs for the wholesale settlement space. They seem to think that it's going to be useful in trade and supply chain. They have done testing with a lot of different technology providers and with governments, right? And banks and different in private equities with bonds. So I would say definitely take a look at everything that has been done by Ubin. They've been great leaders, I think, in this space.
Yeah, I like the Ubin's this wonderful example of a central bank that researches technologically with all their different trials and produces research. Canada is another one of those. I also like the research out of the ECB, even though they haven't been doing as much technical research, but they did do joint work with the Bank of Japan called Project Stella that has researched confidentiality and auditability and synchronized cross-border payments with CBDC. But they produce a lot of great economic research out of the ECB as well about tiered interest rate payments for different account sizes of CBDC and different incentivizations you can do there, as well as a big report they just released on CBDC in the Euro area, which to clarify doesn't mean that they think they should do it, but that they closely follow it, they research and monitor it, and they lay out the benefits and the downsides and ask for public consultation as part of their evaluation process.
Yeah, I just on my side, I like the Bank of France trial looking at CBDC in the wholesale side in terms of settling tokenized bond using CBDC. So they have done a trial earlier this year using digital euro and also using a sort of a tokenized bond as well. And I think that is one of the use cases that the European regulators are looking at in terms of how do we enable an environment where financial instrument could be tokenized in terms of its financial assets, and also using CBDCs as a mode of payment. So that's a pretty interesting project, and the experiments have shown that it works. What is interesting about the project is they did the project in the context of the current European environment to see that this actually works. And I think they are now obviously looking at how do we enable regulations to promote CBDCs and the use of tokenized securities. There's a consultation that is ongoing. It just started this week on looking at regulations around central CSD regulations in terms of how do we enable a post tokenized world where you can settle securities using CBDCs in the context of a tokenized security.
I'm very interested in digital financial inclusion and really understanding the correlations between the CBDC initiatives and how they improve the financial inclusion outcomes, because it seems to me that is supposed to be the driving policy objective behind moving towards CBDC. So I'm very curious to see whether in fact they are able to realize those goals.
I have some thoughts, Helene. I'm very curious too. I think that not enough implementation in the space of financial inclusion for CBDCs and stablecoin has been done to actually see if it does work. But in the case of emerging markets, there are still issues with connectivity, with devices, a lot of basic feature phones that would prevent some of the use cases to actually make sense in that space. There's some work being done with testing offline transactions as a part of those use cases, but it doesn't, I don't think it would add to, it could be useful in down the chain, but like I think at the retail user level, you won't have that experience of a CBDC in depending on where the market is, connectivity, devices, all of that, and identity related issues, KYC.
Just to add on the financial inclusion. So one of the projects I'm really passionate about, because these are good friends of mine, the Red Cross is working with a nonprofit called Grassroots Economics in Kenya. What Grassroots Economics does is stand up what's called community currencies. So these exist long before blockchain, but the idea of we don't have enough cash. There isn't enough money, but we have goods and services, we have skills, right? We have resources and human capital amongst ourselves. So how do we create a better, more efficient network for exchanging what we need amongst each other? And so they people will just stand up their own currency, because at the end of the day, it's social tender, right? There's some social element that says we accept this this claim against each other, that we're good for each other's claims. So my friend Will with Grassroots Economics has been creating these community currencies in very poor remote villages in Kenya since 2010. And since 2018, he's turned them into cryptocurrencies. So these are digital currencies that you can use with very simple feature phones. So you don't need a fancy phone at all. It's just a simple USSD connection into SMS messages, and it's still cheaper than using something like M-Pesa, which is the famous air money, or the way that people send money to each other without bank accounts. So they've created a mechanism that allow people to create a multiplier effect in their local economies, and it's more efficient than M-Pesa, cheaper, and because it's a digital currency, you get all this amazing data in real time in terms of the economic effect of delivering cash aid in the form of this community currency. You can see the impact across men versus women, because they go out and figure out who's got these wallets. You can see it's over 50% women who are using this digital currency and trading and providing for their families. You can see the multiplier effects. So if I airdrop, 1 Kenyan shilling worth of sarafu, which is the digital token, I can see on average there is a greater than 10x multiplier effect. So that 1 Kenyan shilling generates 10 times the economic activity in that region. So one of the things that brainstorming with the Red Cross on, how do we bring this kind of model into the US in a way that's legally compliant, scalable, so that we can help our local economies here, our small businesses here, and create sustainable ways for providing cash assistance and UBI payments. So this is where I think blockchain could show its actual potential, and having a digital identity layer underpin all of that, so we can also be KYC compliant.
Another really quick plug for the UN's Building Blocks project, which has over 700,000 refugees, asylees on the platform, and that's in Jordan, Bangladesh, and soon to be Lebanon. And that's a fantastic project to take a look at for conditional cash transfers.
All right, well, thank you all for your comments there. It's actually a little bit after the hour, so I do want to respect people's time. Thank you all for joining. If you do want to leave, go ahead. There are some other questions here. And so I can go through those to the panelists for those who want to stay for a couple more minutes. Otherwise, please, if you want to see the recording, if you want to see more sessions like this, reach out to Blockchain by Women, join our mailing list, reach out to me or the others on the team, and we'll certainly keep you posted on our upcoming events. But we do have a few other questions here. One of them was on PayPal. I don't know if anyone, if the panelists have an opinion on how PayPal is affecting the usage of cryptocurrencies. Shaylee, have you seen in your work at Ethereum, Consensus, any impact here? Or
I think it's just, it's been great for the industry. I feel like it brings credibility Now I can tell my mother, like, what I do is actually legitimate because she knows about PayPal, right? 360 million users, 30 million merchants. So I think they have some ambitious plans per whatever's publicly available, and it's great for the entire industry.
And we do have a question here on how stablecoins and CBDC issuers can play together. Can you guys talk a little bit more about the use case, where they would work together?
We discussed it a bit in the comments. One scenario we agreed on was, okay, CBDC could back stablecoins as the reserve assets. I couldn't really think of many others that I thought would be likely to happen, but maybe others have ideas. But a good part of that question was also asking, will they compete with one another?
Yes.
Or like outcompete one another? I think where CBDC exists, it would be used much more than stable coins would be, because it's the fiat currency. It doesn't require the use of cryptocurrency exchange or blockchain-based applications. It may or may not use blockchain at all. It could be like very widely accessible, whereas stable coins would be used in blockchain applications by people who could access those, are comfortable using those, and want to deal with the operational risks involved, including instability of the asset to its reference, whereas CBDC doesn't have that risk because it is the sovereign currency. But my colleagues may have other views.
I think governments are, I mean, stable coins are moving pretty quickly. They have a fantastic user interface. I think they have a lot of use cases, not just for like DeFi. I mean, Karen stated one, paying staff cross-border, not having to deal with like the currency, the exchange rate issue. So I actually think if governments let stable coins happen, they're ready to go. It's just, you know, it's about control and monetary policy and the implications there. But governments need to catch up if they and be just as user friendly as stablecoins if they want to keep up.
I mean, I couldn't get. Yeah, Shaylee, I just wanted to follow up with what you were saying there. I couldn't even find Starbucks gift cards that worked internationally. So, you know, it's very limiting right now in terms of what you can do if you have employees around the country. And with COVID, I mean, all of us are online. We're increasingly global. If you just look at this call, right, we have Singapore and all over the US and, you know, and all other calls, there are multiple people from many different countries. So we need a mechanism and a better way to handle these cross-border payments. But with that, I'd like to thank everyone for your thoughts on this. And I think the audience has also been very thankful in the chat for all the panelists' input and your insights. So if you have any more questions, you know, from those in the audience, we're happy to answer them. If we didn't answer them in full, we will certainly do so, whether it's in a blog or a follow-up sort of vignette or short video. So please let us know if there's anything else you'd like to hear about. So again, thank you all for attending. If you have particular thoughts about topics you'd like to hear more about, please let us know, and we'll be seeing you on our next event. So just a quick rundown on our next event in the new year. We'll have a series on data-driven investments, looking at it from an execution point of view, as well as investments in companies. So looking at investments, both digital securities and companies. We'll also continue this series on CBDCs. So this is not the only one we're doing on CBDCs. This one was more focused on policy. The next one we're doing is more focused on technology. And we'll do a whole series on cryptocurrencies, digital securities, and digital currencies and security. So going into some of the questions that we talked tonight about how are we going to handle, say, CBDCs if, you know, all the people in the world have some kind of CBDC on their mobile phone. How is that going to work? So a lot to talk about, and excited to discuss those different issues with you. So let us know what else you'd like to hear about, and thank you for joining tonight.
Thanks, everyone.
Thank you.
Bye-bye.
Thank you all.